Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're live from Bloomberg's inaugural Women, Money and Power event today. The opening trade's an hour away here in London. Here's what you need to know. Chinese stocks continue to gain after Beijing's leadership makes its strongest pledge in years to boost economic growth. Exports from China surge ahead of new tariffs anticipated from the Trump administration. Mending relations. Bloomberg learns Italy's government is in talks with Fiat owner Stellantis as it looks to save jobs in the auto sector. Plus, Citigroup's CEO Jane Fraser on progress on her 5-year turnaround plan. We'll bring you our exclusive Bloomberg conversation and more big interviews from Bloomberg's inaugural Women, Money and Power event.
In the meantime, a quick check on these markets here. When you look at the futures picture, you are seeing a little bit of a turnaround in risk sentiment, down about 0.5% when you're looking at Eurostoxx 50 futures. The same story for the FTSE 100. Where you are seeing strength is in that China story. Continuation from yesterday on that stimulus conversation that we had right here on the show. Strength in the Chinese yuan against the dollar. Weakness in the dollar as well. A lot of that a function of the yield story. 418 on the U.S. 10-year. The countdown to the opening trade starts right now.
Tuesday the 10th, good morning folks. We are on the road, we are at Bloomberg's first Women, Money and Power event. And believe you me folks, over the next couple of hours, we've got all three in abundance. We are going to be speaking to Danielle Polly, Managing Director and Assistant Portfolio Manager at Oaktree, NataliaTsitoura, Apollo, Head of European Origination, and Walsh, can't wait for this conversation, Managing Partner at Guggenheim Partners. And of course, we are going to be speaking to Joan Solatar, Global Head of Private Wealth Solutions at Blackstone. Ida Liu is going to be joining us in the second hour, Head of Citi Private Bank. Guys, this is a fantastic lineup. This is an amazing event. It is amazing to be here.
It is fantastic to be here. And we've got a couple of things to do today. We've got to focus attention on the fact that women are playing a bigger role in the economy, making more of those decisions, holding more of that money, wielding more of that power. And we also need to give a platform to women to do what they do best, which is to come to us, to talk to us about wealth management, about private equity, about private credit, and all the other things that are on our agenda every day here at Bloomberg.
Yeah, and I think we have a kind of a responsibility, of course, to put the spotlight on women. But we should also point out that some of the changes we talk about in the macroeconomic environment, the dynamic between private and public markets, so much of that is driven by women, actually, at Apollo, at KKR, at Citigroup. We'll talk about that in a moment. It makes sense that it's almost overdue.
Yeah.
Why is it the first? I guess is the question that we should maybe ask ourselves this morning. It is an amazing event. We have not only got this show on the road, we're going to be live here for the next couple of hours, but throughout the day, we've got some really amazing panels that are going to be coming up, bringing together, as you've indicated, some of these fantastic women that are running some of these fantastic businesses, maybe giving us clues as well about what 2025 is going to bring and what their reflections are on 2024.
Absolutely.
What have we learned?
I'm looking forward to hearing more from our conversation with Jane Fraser. We'll get to that in a moment. But in the immediate moment, we have to return to the news. But also, I'm wondering who bought breakfast, because we are on the road.
Haven't you had breakfast?
We seem to be undersupplied with breakfast right now, so we'll try and rectify that in the first break.
Anna's got coffee, but I'm
very
glad that it's pointed.
We may get a buffet show up on this set soon.
That's a brilliant idea. That's what we need.
That's what this show is. It's a breakfast buffet of all the news that you need to know. Let's talk about some of the news that we are focusing on this morning. So this time yesterday, we were starting to get indications out of China that we were going to get a fairly major announcement when it came to the stimulus story. Chinese markets gap higher. We saw a very strong reaction to it. We faded that a little bit since then. I wonder whether Chinese investors around the world are becoming a little bit more cynical. We've got the talk. Do we have the walk?
But the differentiator, and we had talked about this on literally 24 hours ago, this is the very first monetary policy shifts in 2011. We've seen so much of the fiscal, we haven't seen it show up from the PBOC yet. And perhaps that is what the Chinese yuan is reflecting this morning.
Yeah, and John Liu helping us put the focus on that just yesterday, and that seems to have grabbed attention. But also a lot of question on, yes, there was fiscal before, but was it all around infrastructure and corporates? And will this now be about consumers? And that could make the difference for the international economy. Really interesting to add into that the export and import data that we've had out, and the import data really underlying the sluggishness of the Chinese economy. So that's worth a note. And the export boost that we're seeing out of China as those Chinese exporters try to get ahead of some of the anticipated changes that we'll see in tariffs coming through from the Trump administration.
What is it going to mean for the European Open this morning? I do caution that we gapped higher first thing and we have faded. So I do wonder whether that's actually a negative signal going into the European Open this morning. I would, though, maybe factor in what is happening in the metals market, where we are actually seeing some fairly positive news. We are seeing prices moving a little bit higher. So maybe that's good for the London market. But I wonder whether we've already had, from a European perspective, the good news.
Yeah. And pairing back that monster move, by the way, specifically in that luxury sector, we had this conversation, is that the right play at the end of the day? We might also see some weakness in the tech sector as well, off of the likes of Oracle. They came out, they met their expectations. The numbers were actually fine, bang on target, but perhaps that's the problem with these earnings at a time when Oracle's trying to compete with the likes of Amazon, Microsoft, Google. Being an A+ student is not enough anymore. You have to overperform. You have to exceed expectations.
And yes, I'm triggered
by that analogy.
Yeah, I am triggered by that analogy as well. I mean, how much higher can you go? A couple of the sort of flies in the ointment then. Bookings looking a little bit light when you looked at it quarter on quarter. And then all of the guidance for the next quarter looked a little bit light as well, whether that was revenues, profit. I know. But as to Kriti's point, it seems that even an A-star student isn't enough right now.
Guy doesn't know what that's like.
No idea. Stocks are 80% this year. So the last time it had a similar performance was when? 1999. I just want to flag that as a little historical moment. The last time we saw a stock performance like this was back then, and we know what happened after that. It was interesting yesterday, the momentum factor in the market didn't do well. In fact, it had one of its worst days in a very long time. So this momentum narrative that has driven these markets this year started to fade quite significantly yesterday, and that's maybe something to pay attention to too. Nvidia was down quite sharply yesterday as well.
Yes, that was all part of that tech. A rethink on tech, perhaps, at least at the margin, given that move in momentum that we saw.
Absolutely, and I think it's also, it brings back to the Oracle story, which is as well that this is the only name that's kind of had the old guard in tech, the Intels, your Dells, for example, that's actually actively trying to compete with Nvidia, Microsoft, Google as well. And I think that's pretty important because the names that you just mentioned as well, those are the ones with the highest valuations. Oracle, pretty high as well, but less relative to Nvidia, for example.
Everything is below that line. Everything is below that line. Let's talk about the European car sector.
Sure.
It looks like Stellantis is trying, with John Elkann basically at the helm, is trying to generate a better relationship with the Meloni government in Rome. That seems entirely logical. Tavares basically knocked that relationship around really, really hard, so they're trying to put it back on an even keel. You do wonder, though, whether you're going to see a fight between European governments for production.
Yes.
And you look at the problems they're facing in Italy, they've got super high costs in terms of the labour costs, they've got a high energy cost story as well. They're going to have to put the high margin cars there. If European governments want to get the car sector going, isn't the simple thing not to actually just squabble over where production is, but to actually get the EV story moving again?
Yes, but there might be some of that squabbling that you reference. And we do know VW, of course, is currently facing strike activity. You know, Stellantis certainly not the only business that's struggling with a lack of EV sales at this point. But you do have to wonder what the quid pro quo is going to look like here. If John Elkann and Stellantis are going to commit to put more or to keep more jobs in Italy, what kind of support from the Italian government is that going to require? That's certainly going to be something we're watching.
And I think it's crucial as well when you take that bigger picture, step back, is that's a dangerous kind of path to go. And we saw it with Biden. He incentivized some of that. The U.S. administration, and then they roll back. And a lot of these EV makers that are dependent on it then have to kind of recalibrate. So it could be a short-term boost for potentially some long-term pain. Let's talk about what else is happening throughout the rest of the day as well, because there are a couple other data points you want to keep an eye on. 11 a.m. UK time, U.S. NFIB Small Business Optimism Survey. We usually don't pay attention to that, but right now, in terms of the move you are seeing in the small caps, it's worth paying attention to that consumer confidence sentiment around that story. At 6 p.m. UK time, we've got an auction in the States, the 3-year, $58 billion worth. Is there still that demand for that part of the curve? We will find out today. And then, of course, we've got the EU finance ministers meeting as well. And that's going to be crucial. We had Oliver Crook talking about this in the last hour. He'll be joining us later in the show as well, talking about what that looks like in terms of the Mercosur deal, among many, many others. Let's get back to our big story here, because we are, of course, at the Women, Money and Power event here in London. I feel like our headliner is, of course, the interview with Jane Fraser. She's staring down her skeptics. That's the subject of today's Bloomberg's Big Take as well. The Citigroup CEO previously said she needed 5 years to pull off Wall Street's most elusive turnaround. Now, halfway through that period, she says she's committed to her goals. Fraser speaking exclusively to our very own Sonali Basak. Take a listen.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about, we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade on the restructuring plan, what would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
Speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
Oh, we have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months, such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. We're delivering, and we're determined to keep on doing so.
Citigroup CEO Jane Fraser there, and of course more analysis from that interview in today's Bloomberg Big Take online. In the meantime, we bring Sonali Baskin, who of course spoke with Jane Fraser, joining us from today's Bloomberg's Women, Money and Power event. I think we have to bury the hatchet later that you flew in for this event, but not to see me. That's a different story. But talk to us a little bit about what you learned from Jane Fraser. You asked her what grade she'd give herself. She declined to answer. Well, Anna and I are over here giving ourselves A+. What are your takeaways from this?
Listen, Jane's tenure running Citigroup is the most historic in a generation, in a banking generation. Not only is she the first female CEO of a major U.S. bank, but she's also untangling, remember, the financial supermarket under Sandy Weill's tenure. So that was everything from insurance to investment banking. And now you have somebody who's largely trying to simplify the bank. And if you were watching this story, it feels like years ago, but it was only January that she said that she would shed 20,000 jobs. There are 11,000 and they have 9,000 left to go. There's a long road ahead still. She doesn't make any bones about it. If you look through the end of 2026, that's really the big moment for Jane Fraser, because she wants to hit returns on tangible common equity. Guy knows my favorite statistic of a bank, and that she wants to hit that number, but analysts believe it'll be 9%. This year it's expected to be 7%, so it's expected to grow, but analysts still expect there to be less than what she said. Now, is she going to be able to deliver that 11%?
So she's facing a little bit of skepticism from some analysts. The regulatory fines an issue, trading losses, all of that. And you cover a lot of that in that conversation. There's plenty more of it you can find on the Bloomberg terminal and on the Bloomberg website, of course. We're here today, Sonali, at the Bloomberg Women, Money and Power event. This one of our headline conversations, of course, leading up to the event. But you're here all day. We are glad, whatever the reason, that you've come to London. So what are you looking forward to engaging with today?
The future of finance. So one thing that's interesting about Jane's tenure as well, and same goes for everybody here at this finance conference, it's that she's navigating this through extreme geopolitical tension. She's also navigating it through extreme tie-ups. Think about how much M&A consolidation we've seen and the push-pull. You were talking about a little earlier, I heard you, Kriti, a bit between private and public. And so, for example, one of the conversations I'm having later in the day is with a group of women running different wealth businesses from Blackstone to Citigroup. How are they handling markets that investors want to have increasing access to illiquid products for? It's still not so easy to get your hands on unless you have mega money, frankly.
Okay.
It's always nice to have a favourite bank metric, isn't it?
It is.
Like
I only socialise with people who have a favourite measurement of banks.
Price to book, mine. Like, Sonali has her own one.
Okay, this clearly has some history. You
And they're trading below it still, but they have improved.
We'll let these two,
Nerd out.
Get to grips with that topic. Thank you very much to Bloomberg's Sonali Basak, who has been, of course, bringing us that conversation. You can catch more from her and the likes of Danielle Polly of Oaktree, Anne Walsh of Guggenheim, Joan Solatar of Blackstone, Ida Liu of Citi, and more throughout the day at Bloomberg's Women, Money and Power event, which is where we are right now.
OK, let's talk about what else we need to know this Tuesday morning. A suspect has been charged with the murder of the United Health Group executive Brian Thompson. The 26-year-old Luigi Mangione was arrested after a tip-off at a McDonald's restaurant in Pennsylvania, where it is alleged he was carrying a pistol and a silencer, both made with a 3D printer. Indian assets, little changed after career bureaucrat Sanjay Malhotra is named as RBI governor. It ends weeks of speculation over who will lead monetary policy in the world's fastest growing major economy. The Princeton-educated graduate's 3-year term starts this week. He, of course, succeeds Sanjay Das, who has been in the role since 2018. And Reuters is reporting that Boeing has restarted production of its 737 MAX. It did so last week, a month after a strike by 33,000 factory workers halted the plane maker's manufacturing. Boeing has around 4,200 orders for the MAX and is getting the production moving again. And this is essential to deal with the company's debt-laden recovery. I don't really understand this story in as much as they've just brought all these workers back. Of course, they are going to restart production on the 737 MAX. What else are these guys going to be doing?
Yeah, I do think I suppose establishing how quickly or slowly they've been able to do that is of some interest, isn't it? Because we talked, whilst these guys were on strike, we talked a lot about the cash burn and how long it was going to be, even if this turned around, which it did, how long it was going to take to get those production lines back up and running, I suppose. And
we talked about other ways that they're going to try to fundraise as well, right? There were reports that they were going to spin off their space business, for example, among other potential contracts. And it's still unclear what that strategy actually looks like.
Boeing looks like a much more slimmed-down business going forward from here. I think that probably is going to be where new management is going to take the business. How quickly they can get there, we've just been talking about the Citi turnaround. This could be a multi-year program that is going to need to put Boeing back kind of on its feet. And during that process, it's also going to have to deliver a new version of its narrow-body aircraft. It's got a lot going on right now. It's going to need a lot of money to be able to do that. It needs happy workers. Are those workers happy? Are we putting some of the problems that we've had in the past with this business firmly behind us? A lot of questions still surround this company. Yes, they're back producing aeroplanes, but I think the future is still slightly more cloudy and maybe potentially turbulent.
Yes, very nice. Too early for Jane Fraser to rate herself. Very, very much too early for Boeing to rate itself and the ability for it to turn its business around. Coming up then, Bloomberg has learned that Prudential is mulling a partial sale of its stake in asset manager Eastspring Investments. We'll check on that stock at the market open. Plus, UK Chancellor Rachel Reeves looks to improve EU economic ties. We spoke to her during her landmark trip to Brussels. Up next, back to the markets. The RBA stands pat, but what will the ECB do this week? What scale of cut might we get from the European Central Bank? We'll discuss that next. If you want to get involved in our conversations with any of the fantastic guests that we have for you at this event, Women, Money and Power, the Bloomberg inaugural event taking place in London today. If you want to get involved in any of those conversations, IB plus BBTV Go is the function to use. This is Bloomberg.
There are some signs that economic activity is softening in a way that's in line with our forecasts, and that's going to help bring down those inflationary pressures. But we've got to get a bit more confident before we're willing to declare victory over inflation.
That was the RBA Governor, Michelle Bullock, there speaking after the RBA's rate decision just happening overnight. Welcome back to the opening trade, live from the Bloomberg Women, Money and Power event here in the City of London. Now let's think about inflation and the impact that that has on stocks. Turning to stocks, and the S&P 500 drifted lower yesterday after hitting a series of records, record after record, it would seem, through 2024. But analysts at Bloomberg Intelligence, or analysis, at Bloomberg Intelligence, shows expectations for next year remain high, with earnings growth forecast forecast to be the best since 2018. We're joined now by Gina Martin-Adams, Director of Equity Strategy at Bloomberg Intelligence, at this very special event. Gina, nice to have you with us. Thank you for joining us. So let's talk about expectations for stocks then, because you think that expectations for stocks are too high. Talk us through the rationale.
Yeah, this is very different this year than any of the last three. Recall coming into 2023 as well as 2024, the implied expectations in equity market prices were for very grim earnings growth to emerge. And this is one of the things that really powered stocks higher in our view over the last couple of years is earnings growth emerged at a much stronger pace than the consensus anticipated, also a much stronger pace than was implied in price. Importantly, that's very different going into 2025. Our work would suggest that the market is currently priced for greater than 20% growth to emerge in the S&P 500 earnings over the course of 2025. That's going to be a very tough bar to match. Recall, earnings growth on average posts somewhere between 8 and 12%, depending upon where you are in the cycle. We could get another third consecutive year of stronger than expected earnings growth, but it would require double-digit earnings growth for the biggest stocks, which is a tough bar to match, considering those stocks produced very strong earnings growth over the course of the last year, and consequentially recovery in the rest of the index, which has been really slow to produce any earnings growth over the course of the last couple of years.
It's going to be easy, isn't it? It's going to be an absolute dawdler. And I tell you why it's going to be dawdler, because inflation's going to come back. Is that effectively what needs to happen in order to generate the kind of numbers that the market is pricing in?
It really depends upon the type of inflation. Remember in 2022, when inflation came back, it came rip-roaring back, and the result was actually earnings compression and a 25% drop in stock prices. So you can have bad inflation or you can have good inflation. Inflation that's generated by demand growth, self-sustaining recovery in the economy, could be very good for stocks. But it's questionable as to whether or not you get that kind of inflation or a supply constraint-based inflation like that of 2022. If we do have tariffs emerge en masse and retaliatory measures as a result of those tariffs, you could have a supply-based inflation spike, which would obviously be very bad for profit growth for the S&P.
When we see Donald Trump take office on January 20th, it feels like we're following the playbook of the first administration. And yet we've kind of gotten a little bit of a taste of tariff comments, et cetera, and the stock market feels a little bit more complacent to that relative to, say, the bond market, the currency market, et cetera. Do we start to see a little bit more sensitivity to that in the stock market going into 2025, or more complacency because we've been here before?
Yeah, it's really difficult to read the tea leaves of the equity market at this time of the year. Recall, even in 2016, the market rallied after the election. November and December very typically are the best time of the year for stocks. We almost always see a post-election rip, if you will. I think the equity market is generally looking for evidence that real tariffs will emerge right now. So far, it's been a lot of threats. Remember, in the campaign, Trump was threatening up to 60% tariffs on China. Now he's talking about a 10% tariff. So net, to the degree the equity market was anticipating a 60% tariff, and now we're only getting 10%, that seems like a gift. So I think that we're going to have to wait until politics become policies. The equity market will default to an assumption that nothing is happening until it really does happen, and then we'll have to price that in.
So we have to wait to get more details on tariffs. In terms of whether we can meet lofty expectations for stocks, Gina, and I understand completely why you're skeptical, talking about inflation being needed and all the rest of it. I mean, is AI structurally a big enough change that this might deliver what markets are pricing in?
Yeah, so far what we see is AI materially impacting tech and communication stocks, only peripherally potentially impacting the rest of the index. So it really depends upon how rapid AI is deployed throughout the rest of the S&P 500, the rest of the economy. Unfortunately, we're at a point right now where AI and AI-related industries really power the bulk of earnings growth. Their earnings momentum peaked in the first half of 2024. So they're facing comparisons on an earnings basis of up to 50% growth going into next year. It's very difficult to imagine they can produce double-digit earnings growth with that comp. The rest of the index will have to start to really spend to power productivity gains. That's probably not going to happen until 2026.
Gina Martin-Adams there, Director of Equity Strategy over at Bloomberg Intelligence. Maybe kind of walking us through a little bit of what 2025 will look like. More M&A talk after this break. Stick with us. This is Bloomberg. 30 minutes from the start of the opening trade. It feels like risk sentiment has taken a little bit of a U-turn when it comes to where we were just 24 hours ago. We did see a little bit of a rally yesterday, perhaps a little bit of a breather when it comes to the future story today, plus balancing perhaps what that China read-through actually does look like. We're going to keep an eye on the bond futures as well, because that's also where you're seeing a little bit of a bid. Net across the continent, it does look like a little bit of a defensive play this morning, Guy.
Yeah, I think in terms of what we've seen over the last 24 hours, the China news has come through, it's been priced in. We've faded that a little bit. But there are a few other things going on. Let's talk about the M&A story yesterday. So yesterday we were talking about a bunch of deals that were getting done. So people are starting to label yesterday as a merger Monday, which maybe is a little bit of a stretch, but where we've been recently, we'll take anything we can get. So we've seen a dearth of deals, you could argue, over most of this year. 2024, a little quiet. So a merger Monday is very welcome. So yesterday alone, there were some $40 billion worth of transactions announced. Of course, Omnicron buying Interpublic. We'll see whether that deal goes through. Could create the world's largest advertising agency. CVC taking CompuGroup privates. We've also got the Bloomberg scoop on a possible deal between Mondelez and the chocolate maker Hershey. Does it continue? Are we going to see many more merger Mondays? What does 25 look like? Danielle Holy, Global Credit Portfolio Manager at Oaktree, joining us around the table this morning at Women, Money and Power. Good morning.
Good morning. Thank you for having me.
So, a merger Monday.
I love the name.
Yeah.
I hope it continues.
Well, does it continue? That is the question. 2025, what does it look like?
Well, I think some of the uncertainty has been removed with President Trump's decisive win, and hopefully, if some of his policies are implemented, including financial deregulation, we may see an uptick in mergers that continues. But I do think some of the pent-up demand that we're seeing today and that may persist in the near term is that uncertainty moved. There's still been a lot to do. I mean, last year and this year, it's been dominated by refinancings, but it's continued to provide opportunities for credit investors like us at Oaktree.
So what does issuance look like next year, do you think?
I think issuance should be robust. I really do. We've got a resilient economic backdrop. We have the potential for falling rates. We have borrowers that need capital for many different expenditures. And I think they feel more comfortable going out and getting it in this type of an environment.
Talk to us a little bit about the kind of high yield space. I'm specifically looking at like the junkiest of the junky, especially in a Trump era where you are seeing so much of that exposure to the oil business, perhaps a little bit of deregulation. At a time when some of those high yield bonds have already rallied quite a bit, is that perhaps forward looking? What's priced into that move that we've seen already?
Yeah, I mean, you always have to be mindful of the lower rated borrowers within any universe. The high yield bond market today is actually pretty high quality. Double Bs are at a 10-year high. We've had a lot of upgrades from that market. So overall, it's pretty good quality. And I think when you think about the recent spread tightening that we've seen, it justifies that. But it's important always to do the bottom-up credit research and, avoid those types of situations where you have higher rates that have impacted borrowers and their interest rate burden. And then while the economy has been relatively resilient, we have seen some companies' EBITDA growth decline a bit, and there probably will be some challenges ahead.
So there's definitely a slowdown. We've seen that in the economic activity. We've seen that in the earnings growth. We were talking about this in the last block as well. But when it comes to, say, this conversation of economic resilience, we had the exact same one 12 months ago. We were talking about this. Nothing's really changed. But the concern 12 months ago was that, is this maybe a little too shiny? Is this a little bit too green? Is there some sort of zombification of the markets or of the credit spreads? Are you seeing any evidence of that, or is that kind of something of the past?
We do see bifurcation. Like the high yield market, for example, it's yielding just over 7%, but 60% of that market actually yields below that. So it trades at quite tight spreads. And there are some outliers that are really on the higher yielding spectrum. Those are the companies that haven't been able to refinance in this market because they have capital structures that didn't contemplate base rates of 400 to 500 basis points. And I think those are the companies where you're going to need more creative financing solutions. That's where rescue financing steps in. The private market can offer solutions for those borrowers, hopefully to push them to a better environment.
Yes, and it's interesting you mentioned that. I'm glad you mentioned that, Danielle, because that takes me on to my question. I was going to ask you about the nature of credit cycles right now.
Yeah.
I mean, what kind of credit cycle is this? We talk for such a long time.
Is it a cycle?
Yeah, is it a cycle? We have guests on who's sort of questioning whether we're even in a cycle. There's such big structural changes. Maybe they outweigh the cycles we're used to seeing. We talked for so long about whether surely the Fed can't land this sort of perfectly soft landing, and, you know, it's not looking too shaky right now. So what is the nature of this cycle, do you think?
I think the cycle has a lot to do with the sea change that we've seen in interest rates, moving from 40 years of low to no declining rates to probably something that's more normal. And the market continues to hope that rates will fall faster than they have. We've seen the disappointment for a few years now. And I think there's reason to believe that rates are going to stay higher for longer. President Trump coming in, he ran on pro-business policies, including tariffs and other things which could be potentially quite inflationary and require rates to stay higher. That said, you know, the Fed is looking at the economy, a dual economy, where there is a cohort of lower income borrowers who are really hurting from higher rates. And so I think it justifies some of the pull down. So it's hard to say, but I do think that we're in this higher for longer, where having credit, relying on the carry and the high yield that you can get from credit is going to be attractive.
Okay, and then it's just staying away from the losers, I suppose, in that environment,
Yes.
and the ones that really struggle.
Right.
And you know, does that give you cause for concern around defaults? Because given the ramp up in interest rates we've seen, any uptick in defaults has maybe been just delayed up until this point?
Right. I mean, defaults have been relatively low, especially in the high yield bond market. You are starting to see an increase in defaults in the leveraged loan market, given that they've been dealing with those higher base rates and have floating rate coupons. But private credit has been an area where some of those companies have been able to get financing and more creative solutions. And I think it's going to keep defaults lower in the leveraged loan market than maybe we've seen in the past. But we do need to be cognizant because a lot of the leveraged loan borrowers have loan-only capital structures. They're smaller in size. And so I don't think we can rely on the same type of recovery rates that we've seen in past cycles.
Okay, so what are recovery rates going to look like, do you think, going forward into 2025? You talk about these sort of extraordinary measures that are being put in place, these extra liquidity measures that are being put in place. What does that mean for lenders? What are lenders going to get back? What are lenders looking at in terms of the businesses that are struggling?
It's been such a small sample size today. The recovery rates are quite low. You're getting 30 to 40%, which is below pre-cycle recovery rates. And I have reason to believe that that may persist, especially when you have, you know, these companies where their capital structures were put together in this lower interest rate environment. They never contemplated these higher rates. A lot of it has to do with rates and how quickly they come down and what relief those borrowers
what does it mean
may
for
get.
lenders, though? So you're going to get a low recovery rate, you get a default. If you don't want the default, you're having to put extra liquidity measures in place to make sure that that doesn't happen. What kind of structures are we looking at there? What does that mean for lenders into those businesses?
It provides a unique opportunity for alternative lenders that have more of a distressed, opportunistic focus and who can provide those types of rescue financing packages. One of the things we didn't talk about, but the leveraged loan market, it's had no covenants for so long. So you have holes in these capital structures, and you're seeing an increase in LMEs and other activities. So you can go in actually and provide fresh capital and prime the other part of the capital structure as a result. So other lenders may have lower recoveries because of that as well.
Okay, Danielle, thank you very much. Thank you so much for joining us. Danielle Polly, Global Credit Portfolio Manager at Oaktree. We are live from the Women, Money and Power event, the inaugural such event from Bloomberg. People gathering, you can probably hear that in the background noise around us. People gathering for this event. They'll continue to do that, and the main program kicking off just as we come to the end of this program, so we'll keep beating the drum toward that. And in that spirit, coming up on this program, we'll be speaking to NataliaTsitoura, who is Capital Solutions Partner and Head of Europe Origination on the private debt team at Apollo. We'll get into that conversation next. This is Bloomberg. Welcome back. This is the opening trade. We are around 18 minutes away from the start of European equity trading. You can see that we've got fairly muted expectations for where we head. A little bit of red on the screen in terms of those European futures right now. We are live at the Women, Money and Power event. And let's have a conversation about private credit. The private credit market is red hot right now as private lenders increasingly partner with banks to finance real economy assets. Reinforcing this theme, this week we've had news from Apollo, newly promoted to the S&P 500, striking a deal with Santander to invest in a $370 million portfolio of infrastructure loans. Joining us now is NataliaTsitoura, who is Capital Solutions Partner and Head of Europe Origination at Apollo. Natalia, very nice to see you at this fantastic inaugural Bloomberg Women, Money and Power event. So thank you for being with us here in London. So a lot of assets in the real economy for private credit to get behind. Tell us more about how far that theme goes in 2025.
Thank you very much for having me. So that's a big theme of what we're spending our time in Europe. We think there is so much capital that needs to be invested in companies, specifically private IG companies, in order to aid their journey into whether that's energy efficiency, whether that is digital infrastructure, or whether that's the power that fuels it all. And a lot of that need really needs financing needs long-dated capital that suits our balance sheet very well. So we're spending a significant amount of our time speaking to corporates and putting together bespoke packages in order to meet that demand.
Yes, and we can talk about some of the themes that you're putting that balance sheet and that money behind in a moment. But in terms of the need and the need for private credit versus other types of financing for these businesses, it's all about the time horizon, is it? It's about you're able to take a longer-term view?
Absolutely. So that reshaping of the infrastructure that we're talking about, we think this is a 75 trillion market over the next decade or so. We have printed a number of deals. Intel, the 11 billion deal that you reported, was actually here in Europe. Absolutely, was absolutely here in Europe. So we do think Europe has a really big role to play. So far this year, we have deployed 35 billion. On a year-to-date basis, and there's still a couple of weeks to go. So we do think there is a significant amount of capital that needs to be deployed, and out of this 35 billion, we think this is going to be doubling over the next 5 years.
Sounds like there's more still to come. Maybe she's here going Christmas shopping, is what strikes me.
Can you tell us what's on the list? What's on the Christmas list? Is government holding private back? Europe needs to get on with this. There's so much to do, as you've already laid out. But it feels like European governments are struggling to generate that forward momentum. They talk about kind of crowding in private sector money, exactly what you're talking about. But it does feel as if that private sector money is being throttled a little bit back by governments. Is that what you're feeling right now?
We still see significant amount of opportunity. It is a very different market versus the US. I mean, the US is a very efficient market when it comes to capital markets. We like that inefficiency in Europe.
Okay.
It is... it's a more regional market. The capital market is not as deep. And that means that we have a lot more opportunity to be deploying private capital. And we do think private capital has a really big role to play in terms of assisting that energy efficiency journey and digital infrastructure spend for governments as well as companies.
But therefore, is it going to happen more quickly in the United States? Is this evolution going to take place there more quickly? The need, obviously, for power, et cetera, in the United States, AI, et cetera, is enormous. It's enormous over here, but it doesn't feel as if the cogs are turning quite as fast. Is the spread going to open up even wider?
I look at the activity that we have had so far to date. So, I talked about Intel. We have given 3 different tranches to Vonovia, totaling 3 billion. We've had 3 different deals with Air France. We are seeing significant opportunity in Europe. And yes, the pace might be a little bit different depending on which jurisdiction you look at. But we're very bullish around the need to be deploying in Europe. And we think we have the right capital to do so. It's effectively matching our long-dated capital with the assets that need significant investment.
You mentioned the capital markets activity, and of course, it's no secret that Europe is lagging on that front, and perhaps providing a tailwind to your part of the business. As European governments make more progress on that front, does that inhibit private markets and the ability to access these deals that perhaps other players wouldn't?
No, we don't think so. We have positioned ourselves in a way to provide solutions to to sponsors, to corporates, and also partner with banks across the whole spectrum. And we do think, obviously Europe is overbanked, and we do think there is a big shift towards private credit, and that's throwing significant amount of opportunity. When you look at the US, we're further on in that journey. That embryonic nature of the European market is absolutely what gets us excited around the various opportunities that we have.
So I'm going to throw you a little bit of a curveball question. Don't hate me after this. Jamie Dimon, over at JP Morgan, the CEO, had warned within the year, had said that private credit is starting to look a lot like the mortgage market pre-GFC. Where are the cracks emerging, if any, in the private credit markets, given that some of the covenants, some of the deal structures are getting more complicated? Where's the hesitation?
So when we think about the private credit market, and there's two aspects of it. There's obviously the direct lending, and there's the investment grade side of the market. We think that, especially when it comes to banks, we have been building up our business in order to partner with banks. We have seen significant amount of volume so far this year. Both on the sponsor-backed space as well on the corporate space, we're still, preservation of capital is extremely important. When we look about underwriting these credits, we put some pretty severe downside modeling in case anything goes wrong, and we haven't really seen cracks through the system. We do expect there's going to be a number of issuers that are not able to refinance as we go through over the next few quarters, as they're coming through, hedges that may be coming off. But, I think overall, when we look at, our portfolio, our portfolio is pretty robust.
You mentioned a couple of times partnerships with the banks, and I think post-GFC you've seen a real turnaround in just how much exposure some of these big banks have to the private equity and certainly the private credit space as well. Can you walk us through that dynamic here? Is this a market where you have to be a larger, bigger player like Apollo to be able to deliver on those returns in the absence of your Goldmans, your Morgan Stanleys, your JP Morgans taking a bigger cut?
So we do think that in this market, scale really does matter. And the market is just developing in a way that you have a few scale players that can provide significant amount of capital to corporates on an IG basis, and also provide solutions to clients. And then you have a subset of more niche players. People in the middle are, I think, ones that are trying to kind of reposition the business. And we think that being a scale provider is something that gives you some real advantages when it comes to providing the right kind of solution, having the right kind of product, and being a one-stop shop to your clients.
And in terms of the themes that you're putting, we started the conversation saying we'll get to the themes, and one of the themes is the global industrial renaissance, Natalia. I mean, how long a time horizon do you need to have to see that delivered? We talked about how private credit has its place because it takes that very long view. These are multi-decade themes, are they?
Absolutely. We think it's a 75 trillion market over the next decade alone. I think in Europe we have significant amount of opportunity, and we're only scratching the surface now. There's been, there's a long line of corporates that want very bespoke solutions that, for whatever reason, they can't really find in the high yield market. And when we look also, when you look at the sterling market in the UK, really it's only open to the largest borrowers. So we do think there's a very long line of corporates that we can help with our flexible capital. Okay. And that's what we're spending time on.
Natalia, thank you very much. NataliaTsitoura, a capital solutions partner and head of Europe origination at Apollo. Let's get some stocks to watch. Whilst we've been talking here at the Women, Money and Power events, the other side of the City of London, Lizzie Burden, busy in the studio, keeping track of all those stocks that could be on the move. Lizzie.
Well, Anna, I want to pick up on a theme that you've been discussing there at Women, Money and Power, and that's M&A. We start off in the insurance world. Prudential is one to watch this morning. It's been courting suitors potentially for a partial sale of its Eastspring investments, its asset manager, a partial sale potentially to fund a move into, let's say, areas like private credit. So those shares year to date down 23%. It leaves a market value of around $23 billion. Will this give the Pru a bit of a boost this morning? morning. Flipping over to car making, we're also looking at Stellantis because the chairman, John Elkann, has been having talks with the Italian Prime Minister, Giorgia Meloni, about how potentially they can keep jobs in Italy. There are 40,000 of them. It was a source of tension between the former CEO, Carlos Tavares. One of his big strategies was to move jobs to lower-cost countries. But the question is, what can Meloni offer to keep these jobs in Italy? When, of course, the car makers, all of them, are fending off that competition from China. Stellantis, year-to-date, down 37% this year. Finally, looking over to SAP, two reasons we should keep an eye on them this morning. First of all, the Handelsblatt report that it's looking to leave 3,500 jobs, move them out of Germany. That's out of 25,000 total. But also, we did have Oracle's results last night. Those shares down nearly 8% after market. And this was actually, as you've been discussing, they had quite a good performance, and yet the expectations were so high. So do we see a bit of a read across to S&P this morning? Year to date, the shares up 72%. Back to you, Guy.
Lizzie, thanks very much indeed. So we're counting it down to the market open now, trying to figure out exactly what that is going to look like. It looks like actually Europe's going to open a little bit softer this morning. So maybe the kind of 24 hours on from the China boost, that has now faded. Iron ore is up, so it's going to be interesting to see whether that gives a lift to some of the miners, but copper, etc., are looking a little softer.
Yes, I mean, just yesterday we had the news out of China during our programme about this boost to fiscal and monetary policy. And basically we saw stocks were up by more than 3% in session yesterday in the European equity space. So yes, to some degree, probably priced in some of that China move. We'll see if there's any further legs to that.
Yeah, paring back some of the move we saw yesterday, but then maybe also counting down to the CPI report and then counting down to the ECB rate decision. And maybe I feel like maybe the market's action is in the back half of this week.
Maybe more from China. I mean, we had the Politburo findings or, conclusions yesterday, didn't we? But the Work Council meeting that we had on the agenda is still to come. That's tomorrow.
Absolutely. Are we going to see some action? This is not the event probably to deliver action. It's the event to deliver the talk. We need to see the action. I think we're just counting down to Christmas as well. I think that's really...
Is your tree up, finally?
My tree is finally up. Kriti has been pestering me.
It's been a month. My tree's been up for a month.
The whole show is now complying because my tree is up as well. You'll be pleased to know,
Bullying works.
There is, it's a fantastic Christmas tree outside this building. Okay, we are going to be joined by Anne Walsh from Guggenheim. She is coming up. We are at Women, Money and Power, Bloomberg's inaugural event. More in the second hour. That's coming up. This is Bloomberg. Tuesday morning, good morning. European equities look like they're going to fade at the get-go of trade this morning. Maybe a bunch of factors behind that. It looks like the China momentum may be beginning to fall out of the market a little bit. But the critical thing maybe actually this morning is what we saw in the United States yesterday. A definite fade in the US session. Critical things coming out of that, one of which is the momentum factor, which has been such a big driver recently, had a terrible day yesterday. Is that a turning point, or is this just repositioning as we come in towards year end? Don't know yet, but it's certainly one that's worth paying attention to. In terms of futures, Kriti, what are we watching?
Well, risk sentiment certainly is coming to the downside. Your Stoxx 50 futures down about 0.5%. You are seeing the same on the FTSE 100. To me, what's so interesting here is that in yesterday's session, literally 24 hours ago, we saw the French futures flying. You look back at what French futures are doing right now, only down about 0.3%. So not paring back, Anna, that entire move. And I think maybe that's interesting given the China news and, of course, the political overhang for that region.
Yes, and as we have some important data points coming up later in the week, CPI in the US. Interesting to note that US futures are almost entirely flat right now. Let's have a look at some of the stocks that are in focus for us this morning here in Europe. Ashtead. Now, this is a really interesting one because what does this tell us about the US economy? That this equipment rental business has cut its guidance, but at the same time is saying it's consulting on moving its primary listing to the US. So we'll watch the various dynamics behind that story as we get to the open. Allianz in the insurance space lifting their profit target as they are vowing higher investor payouts as well. So certainly a lot to watch when it comes to Allianz. That could be a better story than Ashtead at the start of trade. Also in the financial services space, keep an eye on Prudential on its London listing. Asia focused, of course, these days. But they are saying that they are considering selling their stake in East Spring. They may seek to sell about 30% of that particular holding, Guy.
Okay, here we go. Time for the European market open. As we count you down into that opening trade, let's talk about where we are expected to go. The FTSE 100 expected to go a little bit soft. It was up yesterday. The CAC was up yesterday. The DAX was down yesterday. FTSE 100 straight out of the gate, down by a little bit, but not by a great deal. We're down by 0.2%. I'm fascinated to see how the miners trade through this story around China. Keep an eye on some of the technology stocks as well. That's going to be interesting in the wake of what we've seen with Oracle overnight. That may ripple into names like SAP, which has got its own news as well to factor in this morning. So we will watch what is happening. The DAX is just beginning to open up. The CAC is down by 0.2% of 1%. So a mildly softer story. Now remember, the FTSE and the CAC were actually up quite nicely yesterday. I don't think there's a significant reversal here. Maybe just kind of a pause, a wait, a watch. We'll see what CPI delivers.
Yeah, maybe not on the kind of index level, but you are seeing a little bit of reversal in LVMH shares specifically. When you look at your index contribution or your breakdown here, it is your biggest index contribution. I'm going to try to get my words right this morning. That is where you're seeing a lot of the pain. You are seeing it in German stocks. You are seeing it in certain French stocks. That's the underperformer. But your sensational six, your core six, you're the ones that you love to pay attention to, that's driving the upside, but perhaps not enough, Anna, to shake this index.
Yes, and when we were asking questions about whether the good news out of China was priced into European stocks, I think the answer is yes, because basic resource stocks, despite an uptick in iron ore, the E-flag guy, down by 1.2%. So yesterday we moved a lot on that story, didn't we? And maybe we're done with that. But it does look more defensive today, certainly with healthcare, the best performing sector, that has a slightly more defensive nature to it then for a trading day.
Yeah, and of course, and as we break down what's actually moving this, we should give a little bit of love to Stellantis here as well. We're getting a red headline crossing the Bloomberg terminal that Stellantis and CATL will invest up to 4.1 billion euros in the EU battery venture. This also comes at a time when we're talking about Stellantis trying to kind of perhaps in negotiations with Giorgia Meloni's government. We know there's new leadership there as well. They're still dealing with a little bit of the EV story, so that's going to be certainly a
you want to kick
watch.
the EV story into high gear, you've got to do a number of things, one of which is stimulate demand, maybe provide some sort of charging infrastructure, critical as well. You also need the batteries, and that is where Europe continues to struggle. We've seen what's happening with Northvolt.
Yes, I was just looking for a bit more detail on this. So Stellantis and Chinese and CATL, that business, they're planning to invest as much as 4.1 billion in a new plant in Spain. There we go. That was the bit I was looking for.
But this is getting people
geography
to invest in Europe.
Yes.
Because Europe is going to struggle to provide its own batteries by the looks of things. A lot of these batteries are going to come from Asia, from China. Are they going to get manufactured in Europe, though? That's what Europe really
and the
wants.
Northvolt story, as you mentioned, really giving us pause for thought about Europe's ability to deliver on that particular story. But we'll watch this one.
Everyone's certainly scared about that. But I should just mention the price is down about 0.5%, so not seeing maybe a ton of love for the stock, despite this, this perhaps of a positive move.
Meanwhile, we are at the Women, Money and Power event. People are starting to gather for it. Background music is amping up. I'm not sure if anybody else heard the music. We heard the music at the top of the hour.
That was the music for the market open.
Ah, okay, excellent. Well, I'm very pleased about that.
It's not just in our heads. Either that or they're playing music for us.
I'm hearing 5 things in my head this morning.
I'm ready for the dance party. Maybe they were bringing a little bit of music to introduce our guest. Joining us now around the table, Ann Walsh, CIO of Guggenheim Partners. And a pleasure to have you on this program. Look, let's talk about these stock markets to begin with. The ongoing debate around this table between us three has always been: are stocks overpriced? Is this something you want to get yourself exposed to in 2025, or is this something where maybe the party's a little bit over, where the music has died down, for lack of a better term?
Well, certainly in the U.S., what we've seen is post-election, we saw, I think, a pull forward of quite a bit of performance expectation. And a number of things are driving that. Expectations around deregulation, expectations around the continuation of the Trump tax cuts. And all those were positives. But at the same time, it does seem that we also have to remember that there's earnings. And I think we are priced to perfection. And the risk premium is as low as I think I've ever seen it.
Yeah.
And so as a result, I think that there is some risk here. But I think that stocks in general will continue to perform because I think as these policy elements play out, that's probably positive for risk assets generally.
So risk assets in, say, you talked about the United States, let's talk about Europe for a second. What do you need to see to be more optimistic about Europe at a time when I feel like we've been talking about this for years, where Europe is underperforming, dealing with infrastructure issues, not very much doesn't have very deep capital markets. What do you need to see from Europe to say, I want exposure to that?
Well, on a fundamental basis, quite clearly, Europe has struggled, and I think will continue to do so. Frankly, the geopolitical risks which really in previously stable governments weren't expected. We're seeing it obviously in Europe with France. We're seeing it in Asia with South Korea. These are elements that are added into the level of risk that we weren't really pricing in addition to the fact that we still have weakness in manufacturing, and we still have an economy, particularly in Germany, where we're still seeing recession pressures. Given all of that, the fundamental story is not nearly as strong. Now, if I'm a fixed income investor, I'm still seeing the fact that yields are going to continue, in our view, to drop in Europe. And as a fixed income investor, I think that the spread between U.S. Treasuries and, for example, German bonds is going to continue to be wide, giving a little bit more opportunity in the short run, at least, to Europe in that place.
Yeah, mindful of that spread, then, Anne, are you looking for more support from the central banks in Europe, from the ECB in particular? We're looking ahead to that later on this week, and there's expectation of 25 basis points, not wanting to signal panic. Should there be a little bit more urgency, if not panic, around what we get from the ECB?
Well, relative to history, central banks want to go slow and thoughtfully. There's still a risk of inflationary pressures. The worst case in Europe would be some sort of a stagflation. I'm not calling for that, but at the same time, they want to be thoughtful about that risk. So I still see 25 basis points. Whether they should go more to stimulate the economy, I think there's an argument, but I think 25 basis points is probably what's going to happen.
Yeah. I mean, thinking more globally, we were talking to Gina Martin-Adams from Bloomberg Intelligence earlier on today, and she was saying when you look at what's priced into stocks over in the United States, shall we go for a moment, she was saying that those valuations, they're assuming quite a lot of pricing power from US corporates, a lot of inflation, and maybe we don't get that good kind of inflation, maybe we get the bad kind of inflation that's driven by supply shocks and the like. Are you concerned about the resurgence of inflation then in the US?
I think globally we are in a reflationary backdrop. There's a lot of economic movement, the reshoring to the U.S., the cost of digital build-out, power build-out, any of this kind of investment that's having to happen, infrastructure, you name it, that creates some pricing pressure. Small amounts of inflation, say 3 to 4% in that reflationary world, is not a bad thing as long as you have growth and productivity to go along with it. And the challenge is whether we're going to get that. And I tend to be a little bit more optimistic in the long run, particularly with the technology investment and productivity that will come along with that. But I think it's going to take a little bit of time to play out. The concern is short-run inflation. Now, I still believe that the Fed will actually be effective in bringing down inflation a little bit more. Obviously, we have CPI and PPI this week. And nothing moves in straight lines. We could see some parts of the inflationary story continue to be on that downward trajectory, which is what we expect, but against this reflationary backdrop. So there's a lot of pressure on central banks to be thoughtful with regard to policy.
Great to see you, Anne. Let's talk about which consensus trades in the market do you have the biggest issues with?
The consensus trades I have the biggest issues with?
What do you think is wrong right now? What do you think the market is most certain on that could not happen?
Well, I do think in terms of equities, this huge amount of positive bull market sentiment is always a risk. When you see this consensus trade be so large, where I think what's probably more at risk is the level of earnings potential. Not necessarily that we're going to have good earnings, but that we're going to have those good earnings. Yeah. And I think that's a risk. This pricing to perfection, if there's anything that could happen, it will put pressure on the markets. The other element, I think, is that we're going to see interest rates either go way higher or way lower.
Which one is it?
Exactly. It's neither. Our view is that we're trading in a range in the U.S., particularly in the 10-year, so really between 3.5 and 4.5, and we're going to stay here. Now, it's an actionable trade. You can extend duration when rates go up to 4.5. You can shorten duration when they go down. And I think that is out of consensus right now. And I think that's really the pattern. We've been in that pattern for 2 years. With the Fed coming down in rates, that's taken the top off of it. I don't see 5%. So 4.5 to 3.5, really.
Is Trump going to be good or bad for equity markets?
I think what we're going to see is a play, if you will, a game of badminton between politics and policy over the next couple of years. And I think policy, at least at the outset, sounds for the most part pretty good, with the exception of the question of tariffs. I think tariffs are still more of of a negotiating gambit than they are necessarily where we're going to see across the board tariffs everywhere. I think they're going to be more targeted. I do see tariffs, but I think they're going to be targeted.
I've never heard markets described as a game of badminton. That's fantastic.
Not tennis.
No.
Badminton.
I'm trying to work out what's the difference in my head. I'm sure it's
a little bit more air involved, I think.
Carefully crafted metaphor. We like that.
You talk about this reflationary backdrop, though, and when we've seen the first Trump administration as perhaps an initial playbook of that impact on tariffs, et cetera, in this iteration, if we do see that reflationary backdrop, where is the burden placed? Is it on commodity costs, supply chains, corporations, or is it on consumers and a U.S. consumer and hitting savings? Who bears the brunt of that, and how do you trade it?
It's a really interesting question. I think if we see targeted tariffs, as I expect, more associated with, well, I can say China will see some tariffs. I do believe that. But Europe or other countries, it may be more about how other countries can affect or help the Trump administration with policy, whether it's reducing the drug trade through Mexico or, or EVs or something more specific. And of course, also, digital cyber security, any number of those kinds of things. Then I think that probably corporations bear more of those targeted costs relative to consumers. If, however, we see more broad-based tariffs, I think then the consumer could definitely be impacted.
We were talking also with Gina a little earlier on about AI and whether this was a big enough structural trend that sort of compensated for maybe some of the other downsides that we're thinking about in the economy right now. And she was saying what's key right now with AI and that theme is whether it spreads from where it is right now with the superscalers and with a lot of the hard tech names, and when it starts to really spread into the rest of the economy. We talk to lots of CEOs who tell us, well, we've been using AI for 10 years, and that makes you think, well, maybe is it such a big deal then? So what are you expecting this to deliver then, Anne, when it comes to the global economy?
So I think we're in really, really early innings of the artificial intelligence and technology boom that we're going to see. I'm very optimistic in the long run for the impact on productivity. Right now, we're just sort of building out the framework and the infrastructure to support that technology that's going to really take us into the future. So in truth, I think that we have a long way to go, and the productivity improvement will be huge. In certain industries in particular, for example, healthcare, we're going to see amazing innovations as a result of artificial intelligence. We haven't even begun to see yet. And so I think that if you take a very long view, we've got a great outlook for the benefits of AI.
You could have said the same thing about the internet. We'll figure out. It's going to be amazing. Just don't know who's going to be the winner yet. Right. There's a lot of money piling in right now. How much of that money is going in blind, and how much of that money is going in a focused way, do you think? Does there need to be a winnowing process? Do we need to kind of figure out what's working, what's not working, and when does that happen?
Well, again, I think right now the build-out is in infrastructure. And we're very positive on digital build-out and data centers and other kind of investable ideas in the actual framework to support the technology. Right. But with regard to the individual companies right now that everybody's playing in terms of artificial intelligence, we actually even haven't seen the companies that will actually come to market at some point in time that will really drive the technology implementation and usage.
And that's where the real value is going to be, is it?
Exactly.
So it's not going to be in NVIDIA, it's going to be in some company that we haven't figured out yet.
I think that's right. And I think that right now NVIDIA is great because there's a lot of build-out that still has yet to occur. But there will be other companies that actually have applications of artificial intelligence and robotics and all the other platforms that we're going to see that haven't even been.
You don't have a little idea in your mind as to what those companies are? Because that feels like you want to get in at the ground floor.
I'd love to. And I think sitting in private equity right now.
Okay.
Are there capacity constraints involved with that, for example? I mean, you're talking about this ripple effect, but things like the grids, for example, we talk about in the States, we certainly talk about it here in Europe. And that seems to be, you brought up private equity, that's where the juiciest deals are, right? These infrastructure fallouts. But the pushback that you get from that is that capacity where you want to invest doesn't exist, especially in Europe. What kind of time frame are we looking at to actually identify those? Is this a 10-year-long or beyond project?
Well, when looking into my crystal ball, it's a little bit challenging to define a timeline. But what I would say is that if we look at the internet as an example, it was decades long. I mean, when we started in the 80s, we were dealing with barely some spreadsheet technology, and then into the future we developed that. Now we're going to take those spreadsheets and we're going to turn them into artificial intelligence solutions. And so it's going to be a multiplier effect, but it's going to also play out for a long time. And the technology will improve upon itself as well. So I don't see this as being a slow, and short process. I see this as being a very well developed but timely and timeline-long process.
And it's super early for us. It's super early for you. Thank you so much for stopping by to see us this morning. We really appreciate it.
Absolutely my pleasure. Thank you so much.
Thanks so much for joining us. And Walsh, CIO of Guggenheim Partners. Let's talk about where we are with these markets this morning. Let's take a look at the core six and figure out what is happening at the centre of gravity here in Europe. We've already indicated that we are seeing some weakness coming through in terms of some of the luxury names, and you can certainly see that in LVMH. LVMH was up quite strongly yesterday on the China stimulus story. We're giving some of that back this morning. It's interesting that Ferrari is fairly flat this morning, the auto sector in focus, but more with the Stellantis story. Nestle's a little soft. Novo is coming back. It does, as Anna said a little bit earlier on, feel like a more defensive maybe market this morning.
Yeah, a little bit. We are live at the Women, Money and Power event. We keep saying that, and it's worth keeping mentioning because we're on the road. Very excited to be here. You can keep across all of the news flow that's coming through from this event. There's a live blog on the Bloomberg terminal, of course. You can find that on TLIV Go. And I'm going to be hosting for the digital audience. I'm going to be hosting an event, a Q&A session with some of our fantastic reporters who are here. We talked a lot about M&A, so Ruth David's going to join us on that Q&A panel a little bit later on. We've had a lot of news from the finance sector, obviously, because that's what this event is all about. And so Jenny Serrain is going to join in that Q&A a little bit later on. We're also going to talk about crypto, and there's a bit of a future of finance element to it as well, and what the Trump administration means for the crypto space. So plenty to come when it comes to that Q&A. A little bit later on, live here from the City of London. Coming up on this programme, though, the UK and the EU are set to hold formal talks on resetting ties from next year. This, as Chancellor Rachel Reeves says, Britain wants to deepen its relationship with the bloc. More on that next. This is Bloomberg.
Welcome back to the opening trade. We are live from Women, Money and Power. We are 20 minutes into the session. European equities look a little soft this morning. You've got healthcare stocks up and you've got mining stocks lower. That's the general trend, but you need more specifics, don't you? Let's get some more specifics on what's happening in this market with Lizzie Burton.
Well, Guy, I hate to be the bearer of bad news, but let's start with Ashtead. We had that red head crossing the terminal earlier in the programme. Ashtead looking at moving its listing over to the US, and already that knocking the FTSE this morning. Those shares down 7.5% now, about 8% earlier in the session. Also cutting its guidance this morning. So a blow to the FTSE, but flipping over, more bad news. Delivery Hero shares also down. They had been down 10%, still about that now. This is as Talabat, its Middle Eastern unit, has actually turned negative in its trading debut in Dubai. This is one of the biggest IPOs in the Middle East of 2024, but not getting off to a good start, and that transmitting over to Delivery Hero as well. More bad news if we flip over to Allianz. It's raised its medium-term profit target. The CEO vowing to put more money back in the pockets of shareholders. This has been his strategy to try and lift the share price, but it's not enough to impress this morning. And likewise, if we flip over to Prudential, they've been reportedly mulling a bit of M&A, looking at a partial sale of Eastspring investments so that they can fund moves into areas like private credit, and that not impressing investors this morning as well. Finally, let's flip over to even more bad news. We've got the luxury stocks that we've been keeping an eye on, all in the red this morning, because that Beijing boost, it would appear, has already been priced in. Anna.
Lizzie, thank you very much. Lizzie Burden there with some of those stocks that are on the move in what is a little bit of an underwhelming market for this European session. US futures as well pointing a little bit lower. Let's get to some of the European politics, though, that we need to keep across this morning. The UK and European Union are set to start formal talks on resetting ties from next year. Britain's Chancellor of the Exchequer, Rachel Reeves, says she wants to deepen the economic relationship with the bloc to boost growth.
I did not come here today to start a negotiation or to lay down a set of demands. Those conversations about the reset and those negotiations will begin in the new year. But what I was aiming to do today was to begin to rebuild those bonds of trust that have been fractured.
So they're the Chancellor of the Exchequer speaking at that European Union meeting. Let's bring in Bloomberg's Oliver Crook, who's also there for us in Brussels. What more do we know then about the nature of these talks? When the Labour government came to power, Ollie, they were making some fairly limited commitments about how they wanted to deepen this relationship, but going around the world and trying to find untapped areas of mutual trade benefit seems to be one of the strategies they're employing right now.
Yeah, and I think that that is really what Rachel Reeves wanted to emphasize, really trying to make progress, particularly on the issue of trade and trying to boost those trade volumes between the UK and the EU, which obviously have diminished greatly since Brexit and all the sort of other sort of red tape and things that have been installed. As a consequence, there also seems to be some space for commitments on defense and maybe joint action there. And of course, hoping that the sort of the challenges of Europe with the slower sort of economy and competitiveness will drive the UK and Europe together. However, what I will say is that for the journalists who are really hoping from something for the UK Chancellor of the Exchequer, the first one to attend such a meeting since Brexit, it was much more signal than it was of any kind of substance. Whenever we tried to drill down and get a couple of questions to her, where are we actually going to see some progress? Are we going to see some commitment on defense? Are we going to see some commitment on trade? She was very, very sort of couched on all of that language. You know, having covered Brexit for as long as we all did back in London, you know who she's talking to as well. She's referring to the sort of Tory base as well and doesn't want to be seen giving anything up to Europe. So really the devil will be in the details on any of these agreements. And as far as getting any substance there, that is something that will have to be a project for 2025, if at all.
So, Ollie, let's go from one trade deal or former trade deal to another. Let's talk about the Mercosur deal between the EU and South America. Of course, a big success story from Ursula von der Leyen. Walk us through that reaction.
Yeah, what's really interesting is this kind of got buried on a Friday, and the Mercosur deal is kind of like the Capital Markets Union. It's something we've been talking about for 20 years, and nothing seems to happen. And then suddenly we had the signing of Ursula von der Leyen. This is a huge trade agreement. This covers 780 million people in South America and the EU in terms of the size of the market. And this could really have a significant boost for many of the economies that are suffering here, namely Germany. We spoke to the German finance minister about this. Have a listen to what he had to say.
It is part of this strategy of de-risking from China and diversifying. So from a geopolitical perspective, it would be hugely important to send this signal of cooperation to the Mercosur countries.
So from the German dimension, obviously there's a huge economic boost there. There's a geopolitical also consideration here. If you get tariffs from Trump, if you have bigger markets over in Latin America, this could have a huge impact. However, there is still an ability to block this deal. All it requires is 4 member states, 35% of the European population. If you take France, Italy, Poland, and the Dutch, all of whom have objected to material parts of this, namely on agriculture, it could still get blocked. We'll speak to a few of those finance ministers a little bit later today to see where progress is on that.
Great stuff, Ollie. Thanks for the update. Really appreciate it. Ollie Crook joining us out of Brussels. Like the Capital Markets Union, we're still waiting for that to get done. Let's hope the timelines are a little bit more.
Maybe this is Europe's moment to get things done. Crack the whip.
Forged in crisis. Forged in crisis.
I'm bringing the optimism.
Is the much quoted phrase.
Yes. Okay. We'll watch that one carefully. I'm not holding my breath just yet. Up next, we're going to talk about the rise of private markets. Joan Solatar, global head of private wealth solutions at Blackstone, is going to be joining us. Women, Money and Power is the event we're at. As you can see, the room's beginning to fill up. Plenty more still to come. This is Bloomberg. Welcome back. Tuesday morning. Yesterday, the FTSE 100 and the CAC outperformed. They're the underperformers this morning. That's what you're seeing in markets. So you're down by circa 0.5% for those two markets.
Other markets around Europe only down a little bit this morning, and we're going to watch carefully to see how we transition, kind of focusing on China to focusing on CPI. I think that probably is how today is likely to work out. Let's talk about private markets and figure out what is happening there. Huge, obviously, momentum this year. We continue to see a lot of money being allocated to this space. Does that continue? How much more can we actually see being allocated to this space? Joan Solatar, Global Head of Private Wealth Solutions at Blackstone, joins us now around the table. Good morning.
Good morning.
2024 was a year of momentum for your industry. Does it continue next year? How much more can this industry see allocated to it, do you think?
I think it's super early. If you think about the path of travel for institutional investors, 20 years ago they were allocating 5% to privates. Today it's 25% for U.S. pension funds and over 50% for foundations and endowments. Individuals are by and large under 5%. Almost anywhere you go in the world. So I think we have a very long road upward
so
from here.
The opportunity is in the individual rather than the institutional. Is that where the greatest opportunity lies?
Well, my focus is on the individual.
Yeah.
There's still room and you're seeing growth on the institutional side, but I think there's tremendous opportunity for individuals and for insurance companies. You're starting to see them allocate more as well.
You've grown this the private wealth solutions business, Joan, into a giant part of the overall Blackstone business. You've done that by partnering in a lot of ways with banks and other parts of the financial services spectrum. I wonder how much more. You clearly think there's much more to go for here. Is it getting more competitive though?
It's certainly more competitive, and I think the positive of that is you have a lot more institutional quality firms now providing funds to individuals. They're out there educating advisors just like we are. But it is so early. It doesn't matter where I travel in the world. I was just in Asia. I've been spending time in Europe, US. Every firm wants to allocate more to privates. They're talking about these as ways to enhance total return, income, provide diversification for stocks and bonds. So I think it's, again, I think it's quite early.
Yeah, so it's quite early. And obviously the private space and the private wealth solutions that you allow individuals to access is quite varied, isn't it? Anything from private equity to hedge funds and the like. Where do you see the most excitement right now? We've talked a bit about private credit this morning with certain guests. We've talked about private equity. We had some news about Apollo trying to raise the biggest ever fund to attract more money into private equity. Where are you most excited about at this point?
So I'd say today we have the most interest in private credit, where you're getting excellent returns for the risk, and that's attractive and a big spread to what you could earn in traditional fixed income or cash. We're also seeing quite a lot of interest in private equity as well and infrastructure. I'd say the one sector that I think has been a sleeper, but I think in 2025 could see renewed energy, if you will, is real estate. It's been probably the only sector that's lagged, but the sectors we like within real estate bottomed the beginning of the year. Interest rates coming down certainly helps on the valuation side. So I think you'll see momentum build there. But to date, as you mentioned, it's private credit and private equity and infrastructure.
So we keep hearing this conversation that private markets are the place to be, and everyone wants a piece of it. And we were just talking to Ann Walsh as well about the overtaking of these markets from the private space over to the public ones. But how do regular, everyday investors who are so used to being exposed to a stock market get involved with the private markets? It feels like it's something that the ETF market is trying to tackle with varying degrees of success. How do you access it if you're not a large-scale institutional player?
So there are a lot of structures that are now accessible to more people. If you went back in time and you only had the traditional drawdown funds, those you're only allowed to offer those to the uber wealthy based on regulations. But today we have open-ended funds in all of the sectors that I mentioned, and depending on the country, you could access those with a minimum of $10,000 in investments. Some countries it is higher, $200,000, $250,000, but that's much more accessible than it was where the previous minimums were $5 million.
Where are the cracks then? Give us the juicy stuff, Joan. This all sounds great. But isn't that always the case? And before something falls apart, everything sounds really, really great. We've been covering private markets this all year, really. And every time I speak to someone, whether super return or EPAM, it's always been this enormous optimism around it. But I think we've learned in previous iterations that when everyone is bullish on a sector, maybe that's when you have to start paying attention to the cracks. Are you seeing any cracks at the moment?
I'm really not. And I would say private isn't a sector.
Yeah.
And each of these sectors will be cyclical, right? And so the way to think about it is if you're talking about private equity, it just means these are companies that aren't publicly traded, and they actually account for 90% of the investable universe. And the same in commercial real estate.
Yeah.
Over 90% of real estate's private. So if you're only accessing the public markets, you're really just fishing in a pretty small pond.
But in the context of some of these deals and these financings having more covenants attached to them, a little bit more complicated in structure as you see more and more people allocate to it, is that a concern? I mean, Jamie Dimon, I keep going back to this because it was such a juicy quote, has compared private credit to the mortgage crisis in the mortgage market prior to the GFC. Is that a fair comparison?
I don't think so at all. First of all, again, it's you go back in time, but those mortgages were held by very levered institutions. They were based on customer deposits. But what is private credit? These are funds, you're matching liquidity terms. These are senior loans. I mean, we're originating private credit loans at less than 40% leverage. That just does not speak to any kind of bubble environment.
Okay, so mood still good in that particular sector. Joan, whilst we have you here and we are at the Women, Money and Power event here in London, I thought a nice time to reflect on the role of women in financial services. And the reason I thought of asking you is I read something you wrote more than 10 years ago, advice to your daughter in the Harvard Business Review. And you were talking about shouting louder about women's success stories rather than focusing on the things that women can't do. Do you think the conversation has caught up with you on that? Do you think we're better at doing that now?
I do. First of all, I think there has been significant improvement and change, and there's always room for more. But when I started in this business, there really were very few women. And even when I started at Blackstone, the percentage of females in the analyst class was quite small. It's about half now. And my focus has been on sharing success stories and what works, rather than just getting stuck in a negative conversation of what doesn't. We have so many examples of women who are successful in finance.
My advice, by the way, my advice to my daughter is to go to school if she's watching.
If she's watching. What time is it?
That's the first step, isn't it, on the journey? But yes, there we are.
Education. Is there enough momentum? Is the momentum building? How do you see it developing going forward from here? In 10 years, Anna took us back 10 years, and 10 years from now, do you see that there is now a big enough base coming through, a strong enough cohort coming through, that relationship is now so embedded in the system that not the hard work has been done, but that it's going to become easier? The pyramid just has a wider base now to build from.
I do think so. So to your point, if you think about the top of the pyramid, we still have progress to be made. If you look at percentage of women CEOs and the like, whether it's Fortune 500 or wherever you are in the world. But if you look at the base, if you look at the middle, even if you look at partner level at firms, just many more women than there were 10 years ago. And that would suggest those women will continue to rise.
So what needs to happen next?
What needs to happen next?
What needs to happen next to make sure that the top of the pyramid is as well populated as the bottom?
Events like this one, maybe.
I agree. I think it's really incumbent upon successful women and men to continue to mentor and sponsor and push people forward who are talented. That's what I try to do day to day. And I see many more female partners, not just at my firm, but at peer firms. And that's real progress.
Yep, and go to school.
Yes, definitely go to school.
Joan, lovely to see you. Thanks for stopping by to see us. We really appreciate it. Thank you so much. Joan Solatar, Global Head of Private Wealth Solutions, joining us from Blackstone. Blackstone.
You got it.
Not sure where that one went. Coming up, we're going to be joined by Lu, Head of Citi Private Bank. We'll discuss how attitudes to investment differ from generation to generation. Baby boomers passing on trillions of dollars of wealth over the next 20 years. Much of that money going to women. That conversation next. This is Bloomberg.
Welcome back to the opening trade. We are about, I'm looking at my clock here, 43 minutes into today's session. When you look at these markets, you are seeing red on the screen, but underperformance in France. I think that's the highlight for me this morning. You are seeing the entire market down about, we'll call it 4 to 5/10% down, but the CAC Cameron down about 6/10%, perhaps paring back the move we saw yesterday, perhaps even waiting for that political overhang to kind of disseminate. We are still waiting for Emmanuel Macron's pick for Prime Minister, so we will keep an eye on that. In the meantime, we are here. Opening trade is here at the Women, Money and Power event at the Pan Pacific Hotel in London. We've got an all-star lineup of females who are, of course, leading the charge in some of these biggest market conversations, not to mention the future of finance as well. Let's bring in one of those special guests. Ida Liu, head of Citi's private bank, joins us right here at the table. It's a pleasure to have you.
It's wonderful to be here.
Thank you so much for coming. She, of course, will be on a panel later as well. You can already kind of see the energy in the room ramping up. A little bit of excitement there. Let's talk about these markets, though. 2024 has been a banger year for the stock market, arguably for the bond market as well, seeing a little bit of recovery there. Does this continue? Was the economic resilience of this year a surprise?
Well, I think we can sum up 2024 in 3 words: resilience, divergence, and innovation. So on the resilience side, the U.S. market continues to be very resilient. As you've seen, we're almost at 30% up year to date in the S&P 500. That's off the back of a very strong year last year, 24% return in the market. So lots of resilience, strong corporate earnings still in the U.S., driving a lot of that growth. Then we look at the divergence, because the U.S. markets have really outperformed as compared to the other markets around the world, in some cases by 10 percentage points as it pertains to Japan, in other cases larger gaps of valuation discrepancy between the U.S. and Europe, for example, 20+%. So that's all been driven by innovation. So we've talked a lot about the Magnificent Seven and the contributions that the Magnificent Seven has had in the outperformance in the market. That continues to be the case even this last year with outperformance there. But I think that that's going to be pretty different as we're looking into the year ahead.
In what way, though? Because I almost wonder every time the bets against, say, the Mag 7 or some of these other very crowded bets, you can look at it in the currency market as well, show up. The people who short that or say, okay, this rally has gone too far, are continuously proven wrong. Why is this time different?
Well, I don't think that we're going to see a stop in the growth of the Mag 7, but what's interesting is the opportunities around the Mag 7. So the 493 other stocks in the S&P 500 that have a lot of room to grow. We're looking at a lot of small and mid-cap opportunities in the growth areas such as tech, in AI and cyber, healthcare, as you look at personalized medicine, telemedicine, and even in clean energy transition, as you're looking at some alternate sources of energy growth in the future, such as nuclear fusion, hydrogen, solar, batteries, and the like. So some very interesting, I would say, industries and opportunities to complement what we've seen with the Mag 7 going forward.
When you talk to clients, when you talk to investors, are they saying, I'm getting worried, I need to hedge my downside? What are they saying, or are they just all in?
No, in fact, it's quite the opposite. I think our investors globally are very bullish on the outlook for the markets and the opportunities ahead. I think the key there is going to be making sure that you have the right geographic diversification in your portfolios. As I alluded to earlier, you're seeing so much discrepancy between performances in different regions around the world. And how do we position our clients properly to capture that global
So effectively,
diversification?
am I buying puts on the S&P and calls on the stock 600 here in Europe? Is that the way I should think about it?
No, not necessarily. I would think of it slightly differently. I would think about positioning towards some of the industries that we just talked about that are ripe for growth and continued growth going forward. And then looking at some of the dynamics that we're seeing right now with the ongoing bifurcation between the U.S. and China, as an example. So what does that mean for changing supply chains around the world? What does that mean for economies around the world, such as Southeast Asia, that's benefiting from some of the bifurcation between U.S. and China? countries like the Philippines, Thailand, Malaysia, Indonesia are really benefiting from that as well, in addition to India. So making sure that you're capturing some of the geographic growth opportunities in investors' portfolios as well.
So it's about geographic opportunities, diversification. What about managing some of the geopolitical uncertainty that you've described there, Ida? And I'm thinking here about the risk of tariffs next year.
Yeah.
Does it feel in any sense that we've priced in a lot of the optimism about next year, but maybe some pockets of the market are complacent about risks? Or is that not what your conversation with clients reflects?
No, it's always about managing the geopolitical aspects and the risks in investors' portfolios. It's number one on clients' minds, is what's going to happen with all of the change of guards. I mean, you all know that we've had over 60 different elections this year, changing of leadership around the world. I know you've covered every single one of them. Changing of the leadership around the world. So there's massive ramifications as you're sitting there as an investor. Think about, okay, it's really important that we have the right diversification, that we have the right growth industries, that we're repositioning towards where we think the growth is going to be going forward. And that's not just with public markets, by the way. It's also with private markets and alternative investments. So we've seen a ever so increasing interest in alternative investments, private equity, direct investing, real estate assets and the like for our clients around the world. And today our clients are about a third in private market and alternative investing, and our family office clients are about 40% of their portfolios in private markets and alternative investing. So quite significant. It continues to be of interest.
So a third or 40% in private markets.
Yes.
That's a really interesting statistic. How to fit that with the generational wealth transfer and the wealth transfer that we're seeing towards women as well, as we're at the Women Power Money and Power event here from Bloomberg in the City of London. You know, we're seeing a lot of this money passed down from one generation to another. We're seeing a lot of money passed to women at this point, both because of inheritance, but also because of women taking more of a role in global economies. Is there a link between that and the private market push? Are there any dots to join there, Ida?
Absolutely. So we are in the midst of the largest wealth transfer in history. 100 trillion of wealth is passing down to next gen and millennials over the next decade. And you're absolutely spot on that women are going to control a greater and greater share of global wealth. Today, women control about a third of global wealth. That number is going to be well over 50% in the next 5 years. So with this changing dynamic, you're also seeing some important and very distinctive changes in the way that they're investing. So women, millennial, next-gen clients, they are behaving and investing slightly differently than what we've seen in the past, with a tilt towards investing with purpose, investing with impact, doing good with their investment dollars, and then also making sure that their legacy is intact. A lot of planning around wealth transfer to their family members and the like as well.
Okay, no doubt some of the themes that will come up at this event, at this conference today. Ida, thank you very much for joining us. Ida Liu, head of Citi Private Bank. Now, from Citi Private Bank to the wider Citigroup firm, Jane Fraser stares down her skeptics. That's the subject of today's Bloomberg Big Take story. You can find that on the Bloomberg website or on the Bloomberg terminal. The Citigroup CEO previously said she needed 5 years to pull off Wall Street's most elusive turnaround. Halfway through that period, she says she's committed to her goals. Fraser spoke exclusively to Bloomberg's Shonali Bassik.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about, we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade on the restructuring plan, what would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
We have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months, such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. We're delivering, and we're determined to keep on doing so.
Who? That was Citigroup CEO Jane Fraser there, and there's more analysis from that interview in today's Bloomberg Big Take online. We need to continue this conversation, Guy.
We do. So Shonali's back. She's going to be back throughout the day, which is fantastic. So let's talk about what you're hearing and what the takeaway is from this Women on Money and Power event. In terms of what we can take away from what Jane is doing and what she has done, what are the lessons we can learn from her?
Quite a few. I mean, when it comes to Citigroup, it's a pretty specific story, isn't it? But she is tackling a lot of fronts that are very rapid changes on the forefront of Wall Street. You just talked to Ida Liu. She's going to be on my panel a little later.
Yep.
That's going to be a big panel focused on wealth management, but also where private assets fit into wealth management. Of course, Citigroup made that landmark deal with Apollo. But, I also just want to acknowledge here that this is a conference about the future of finance with women put at the forefront of that story. And why is that? We're talking about this now in this manner because you are seeing so few women in the C-suite, but you're seeing more and more women on boards. And it matters because you are seeing more wealth transferred to the hands of the next generation, which is often women. Whether that be generational wealth passed on through wealthy families or women who are starting more and more to start businesses and therefore look for an IPO. Some of the measures, guys, that are put forward are compromised. You think about it, the NASDAQ board diversity rule, will that make it through 2026 in the next couple of years with the DEI backlash that exists out there? Or, for example, Goldman has a rule. Won't take a company public without 2 diverse directors, one being a woman. And so that has existed, it has pushed the ball forward, but will it more in the future?
All right, you got to pick your favorite. I'm going to put you on the spot, 30 seconds. What panel are you looking forward to the most?
Actually, the next one. Jenny Johnson is kind of a hot topic right now. Family really built a mutual fund complex. Can she get into private assets too? We'll see.
All right. Bloomberg Shonali Bassett there, of course, leading some of those conversations she was just telling us about as well. You expect some headlines from key executives today. The Bloomberg Women, Money, and Power event. That is where we are. In addition to the conversation with Jenny Johnson, she was just talking about the lineup includes, of course, more from Citigroup CEO, the head of Man Group, Santander's executive chair, and, of course, Jenny Johnson again, the Franklin Templeton CEO, among just some of the names.
Okay, so those are some of the voices that you'll be able to hear from today here at this event. A TLIV blog following today's events has started for Bloomberg subscribers, so you can log on to that. You can check it out on the terminal using the function TLIV Go. You can also join us virtually at Bloomberg.com and on the Bloomberg Live channel on YouTube. And looking ahead to later, I'll be hosting a Q&A about the event. That is it. More still to come. This is Bloomberg.